Let's talk investment properties. Hey guys, Charlie Shammy, the CEO of a mortgage company called Sonic Loans. We're a multi-state lender located in Michigan. And today I want to talk to you about investment loans. Now, I get a lot of questions about investment loans and what the requirements are for it. There's different types of investment loans that not a lot of people know about. One is the normal conventional types of investment loans. That would be conventional loan, which goes under Fannie Mae or Freddie Mac, and the requirement for that is at least 15% down. There's also what's called non-QM type loans. One of them is a DSCR, which stands for debt service coverage ratio. And if you break down those words, that just means that you have enough rental income coming in, enough cash flow coming in to cover the mortgage payment. So that's what they look at for income. They don't check your income, not your job, tax returns, none of that. Look for income, credit, and assets, and you close. It's another type, and it's a good type, and a lot of people use that type. But what you should be looking for when you're buying an investment property are three things. One, and this to me, what I believe should be the least important one, is cash flow. A lot of folks will say, hey, if I buy this house, here's my mortgage payment, here's how much I'm going to collect in rent. I'm only making $100 or $200 a month. It's not worth it. Well, that's if you're just looking at cash flow, which is the last thing you should be looking at. I have investors that are very savvy, that'll buy a house even if they're negative cash flowing on the house. And here's why. The second one is the magic word when it comes to taxes. And that word is depreciation. When you have an investment property, not only can you depreciate it enough to where if you're getting cash flow, you should be getting that cash flow tax-free. That doesn't mean you don't show that income. You show it, you show the depreciation, your net tax bill should be zero. Of course, talk to an accountant about it. But there's also something else called a cost segregation study. And you see these videos everywhere about cost segregation study. What that is they go into the house, they study everything in the house, like your switches, your doors, your door handles, your cabinet knobs, anything that's not a permanent fixture in the house. They'll give you a breakdown of what those costs would be to replace it. And you can do what's called an accelerated depreciation on those. What does that do? Let's say you buy a house for $100,000, and just for easy math, an example, you're able to segregate $60,000 of the costs in the house. Land you don't get credit for, but costs in the house that qualify for this. So you take $60,000 and you can accelerate that. Instead of depreciating it over 5 years, you can depreciate it on year one. So now you have a $60,000 depreciation. Let's say you bought the house in December for that entire year. That can offset your other income. To qualify for that, you have to be considered a real estate professional. So that's important to know. There's two different caveats there. Talk to your accountant, make sure you're doing that the right way. But if you're considered a real estate professional, now that $60,000 depreciation can go against other income like W-2, self-employment income, all types of other income. That's the second one, depreciation, and that's the magic one if you're able to use that the correct way. If you look at it from the perspective of the government, the IRS has that in there so they can stimulate the economy, stimulate people buying houses. Even though the Federal Reserve right now is trying to do the opposite, those have been in the books. It's part of the IRS tax code and you could use it to your advantage. The third one, and this is an important one that not many people think about, is appreciation. You have your cash flow, you have depreciation, and this third one, appreciation, which means how much is the house going to be worth? You have fears of people saying, okay, housing is going to go down. There's no evidence of that. You have fears of, okay, what if the value goes down? But what if it doesn't? What if it just does what it did past 100 years and just continues to go up? What if that happens? Well, you're getting appreciation. So the increase in the value of the house, you can take that increased value, you can do a cash out refinance on the house, you can pull equity out of the house tax-free, put that money in your pocket, use it for whatever you want, continue to rent out the house and have somebody else pay down that mortgage, pay down that payment so you have something to give to your kids or whatever you want to do with it. So those are the three things that are really important to consider when you're looking at an investment property. It's not just what's my cash to close, it's, okay, what is my cash to close? But let's look at the full picture. Your team should be your real estate agent, your loan officer, and your tax advisor. And those three should be helping you and guiding you to make the best decision for you and your family. Thank you.